Unit 2, the Regulatory and Conceptual Framework of Accounting. Session 3, Conceptual Framework of Accounting 2. By the end of this session, you should be able to describe the contents of the Conceptual Framework of Accounting with regards to recognition and derecognition, measurement, presentation and disclosure, and the concept of capital and capital maintenance. Recognition and derecognition. Recognition. Recognition is the process of capturing for inclusion in the statement of financial position or the statement of financial performance an item that meets the definition of one of the elements of the financial statement, either an asset, a liability, equity, income, or expenses. Recognition criteria. Only items that meet the definition of an asset, a liability, or equity are recognized in the statement of financial position. Similarly, only items that meet the definition of income or expenses are recognized in the statement of financial performance. Probability that there will be an inflow or outflow of economic benefit associated with the asset or liability, and the asset or liability can be measured reliably. These constitute the criteria for recognition. Derecognition. Derecognition is the removal of all or part of a recognized asset or liability from an entity's statement of financial position. Derecognition normally occurs when that item no longer meets the definition of an asset or a liability or capital. For an asset, derecognition normally occurs when the entity loses control of all or part of the recognized asset, and for a liability, derecognition normally occurs when the entity no longer has a present obligation for all or part of the recognized liability. Derecognition simply means removing the asset or liability from the books of the organization. Measurement. Measurement recognized in financial statements are quantified in monetary terms. This requires the selection of a measurement basis. A measurement basis is an identified feature, for example, historical cost, fair value, or fulfillment value of an item being measured. So a measurement basis is an identified feature of an item being measured. Applying a measurement basis to an asset or liability, create a measure for that asset or liability and for related income and expenses. Historical cost. Historical cost measures provide monetary information about assets, liabilities, and related income and expenses, using information derived, at least in part, from the price of the transaction or other event that gave rise to them. The historical cost of an asset when it is acquired or created is the value of the cost incurred in acquiring or creating the asset, comprising the consideration paid or acquired or create the asset plus transaction cost. The historical cost of a liability when it is incurred or taken on is the value of the consideration received to incur or take on the liability minus the transaction cost. Current value. Current value measures provide monetary information about assets, liabilities, and related income and expenses using information updated to reflect conditions at the measurement date. Presentation and disclosure. A reporting entity communicates information about its assets, liabilities, equity, income, and expenses by presenting and disclosing information in its financial statement. Effective communication of information in financial statement makes that information more relevant and contributes to a faithful representation of an entity's assets, liabilities, equity, income, and expenses. It also enhances the understandability and comparability of information in the financial statement. Effective communication of information in a financial statement requires focusing on presentation and disclosure objectives and principles rather than focusing on rules. classifying information in a manner that groups similar items and separates dissimilar items, and aggregating information in such a way that it is not obscured either by unnecessary detail or by excessive aggregation. Finally, the concept of capital and capital maintenance. This is concerned with how an entity defines the capital it seeks to maintain. It provides the linkage between the concept of capital and the concept of profit because it provides a point of reference by which profit is measured. This means that inflows of assets in excess of amount needed to maintain capital may be regarded as profit. Hence, profit is the excess of income over expenses. Expenses here include the amount needed to maintain the capital of the entity. Financial capital maintenance is profit is earned only if the financial or money amount of the net assets of the entity at the end of a period exceeds the financial amount of the net assets at the beginning of the period. Physical capital maintenance. A profit is earned only if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity of the entity at the beginning of the period. In this session, we discuss the content of the conceptual framework of accounting, specifically recognition and derecognition, measurement, presentation, and disclosure. We also discussed the concept of capital and capital maintenance. Thank you.